Howdy, Jacob here. Today we're looking at the company Copart. It is in the commercial services and supplies industry, 47 billion market cap with just under 45 billion enterprise value. Growth is pretty substantial. They produced 1.2 billion in revenue in 2014 up to almost 3.9 billion in 2023. We see that their operating margin is 38% in 2023, and their gross margin was 40% in 2014. So substantial growth on the margin side, and return on invested capital is also growing from just under 15% in 2014 to now 23%. And let's look at this balance sheet. They have about 1.3 billion in liquid assets of cash and short-term investments, and just 11 million in long-term debt. So really no debt here, good amount of cash on hand, very safe company. They have more cash than total liabilities. So that's beautiful. Their cash flow is 5-year out. It's definitely growing. In the last 5 years, it's actually grown from 300 million to just under 900 million. So pretty substantial there. Their use of cash is not a whole lot of use of cash here. We see that there was a huge investment of 1.4 billion in 2023, but the rolling 12 is a sell-off or devastation of 1.3. So that's interesting. It looks like they just accumulate a bunch of cash, which is weird. But you can see it on their balance sheet too. They had 64 million in cash in 2013 to now 1.3 billion in 2023. They have repurchased shares in large amounts for short periods of time. So in 2019, they bought a bunch. 2015, 2016, they bought a lot of shares. That could mean that they're buying back shares when they think their stock is extraordinarily cheap. So that could be advantageous. But it's interesting that they've just compiled a huge amount of cash instead of reinvesting it somehow through, acquiring companies advantageously, repurchasing shares that are hopefully cheap, or reinvesting in yourself. But yeah, interesting use of cash here. Let's start making some assumptions. I'm going to say on the revenue growth side, I could see them. Yeah, they have immense growth here. Let's do 8, 18, and then 15% return. Margins are increasing. I'll probably go towards the heavier end here. Their earnings margin is higher than their cash flow margin, which I don't like, but it's still pretty substantial, so it's not terribly concerning, I guess. Maybe 32, 26, and then maybe 1%. So then, stock-based compensation, 38 million, and they haven't repurchased shares since 2019. Okay, so let's say flat actually over a 7-year period, saying that maybe the stock price will get cheap where they repurchase a lot, and they have just an immense amount of cash. So, okay. Yeah, it just says it's a little bit expensive right now. It needs to fall 73% before you get a 15% return, given these assumptions. I'm just kind of confused that they're just adding to their cash collection. Interesting that they're not, or at least it doesn't look like they're really reinvesting back in themselves and then buying back shares that are hopefully cheap, which is, the two most advantageous things to do for a company that is gushing out cash and still has a bit of growth ahead of them. So, it was just interesting to see that. But yeah, hopefully you enjoyed the video and have a great rest of your day. So, thank you.